All right, guys. Okay. So let's start with today's session. And I thought this is probably a better background than the one I used to have. Right. Okay. So yeah, it tells you, different financial figures, different financial information in the background. Right. Okay. So in today's session, will be split into two parts. In the previous session, when we were talking about equity valuation, we covered most of equity valuation. There is still something that I want to share with you on equity valuation. So in the first part, we'll cover we'll talk about equity valuation a bit more, and then in the second part, which is the main objective of this session. So in that part, we'll talk about the foreign currency markets, which we also call the Forex market. So as I mentioned, this session will be split into two parts, right? So in the first part, we'll talk about equity valuation. So I'll quickly remind you what we talked about equities and how to value equities. So we'll quickly go through that. And then the new information, the new topic that we will cover relating to equity valuation is errors in stock valuation. Then we'll briefly talk about estimating risk. So I'll introduce the basic capital asset pricing model. And then we'll look at the rights issues. In the previous session, we talked about IPO, right? When a company is already trading on the stock exchange, so if it wants to raise more equity, so it goes for secondary equity offerings, and one of the ways it can issue more shares to existing shareholders is what we call the rights issue. So we'll talk about rights issue and how to value those rights issue as well. Right. Okay. So this is something that we already covered. So I'll go through this relatively quickly to kind of give you the same some background or recap what we covered in the last session. So stock valuation is the method of calculating the theoretical value of a firm, right? And then if we divide the value of the firm by number of shares, that will give us the theoretical value of the share or value per share. And the valuation method is very, very straightforward, something that we have learned in when we were valuing bonds, right? So it's simply the present value of all future cash flows, right? But when we talk about stocks, the cash flows can be in the form of dividends, right? If the company pays dividends, they are cash flows to shareholders, right? Okay, so we need to determine the cash flows in order to value the stock of a company, and we need to know the appropriate discount rate. And that discount rate should be reflective of what? Risk of the stock, right? That discount rate should be reflective of the riskiness of the firm, right? Okay, good. So the trading strategies are quite simple, right? You would want to buy a stock that's undervalued, and you would want to sell stocks that are overvalued, right? But the problem is, how would you determine whether the stock is undervalued or overvalued? So using these valuation methods, we estimate what is the value of the stock, what is the theoretical value of the stock, right? And then compare it with actual price, and that will give us some sort of idea, whether we believe the stock to be undervalued or overvalued. Okay, so here's this abbreviation. Here's the formula for stock valuation, right? So dividends are your cash flows. So this is one, if this is like one period investment. If you invest in stock for a year, so next year dividend discounted at your required rate of return, and then the price at the end of the year discounted at your required rate of return will give you the price of the stock today. Okay. So we already looked at this example in the previous session, right? Okay, so here's the formula that we went through in some detail in the previous session, right? Okay, so this is what we call the dividend growth model, or dividend. Yeah, we also call it this is called Gordon's formula, right? To value a stock, right? This is called Gordon's growth model. So we derived all of this in the last session. Okay. Okay. Good. So if we assume that that the dividends would grow at a constant rate g, right? So how would we value the stock? Okay, it's the dividend in the next year, expected dividend, divided by your required rate of return minus the expected growth rate. Okay, good. And then we looked at another valuation method that's based on multiples. So we looked at price to earnings ratio, right? So that's another way to value the stock. Okay, good. Right. So the question is how the market sets the security price, right? So these formulas, these different estimation methods give us some sort of approximation of what is the value or what is the theoretical value of the stock or theoretical value of the firm, right? So, but in market, right, there are other factors that can potentially influence the stock price. Okay, so generally speaking, the prices are determined by the basic economic principle of supply and demand. Okay, so prices are set in a competitive market as the price that the buyers are willing to pay for that item, and in this case, that item is a stock or equity, right? So the buyer of an asset is usually a buyer who can make the best use of the resources or best use of the asset. Okay, and he or she will be the one who will be willing to pay the highest price, and that is what will determine the value of the asset or the value of the stock. Okay, so information is extremely important, right? So if someone has better information, they'll be able to value the stock better than everybody else. Okay. So their valuation is more likely to be representative of firm's true value. Okay, so if someone has an information advantage, they can potentially benefit from their superior information, from this information advantage, and form trading strategies that will enable them to make money at the expense of other traders or other players in the market. Good. So we'll talk about this information advantage later in the module as well, when we'll talk about efficient markets and efficient market hypothesis. Okay, so let's take a quick example. So consider the following three valuations of a stock with certain dividends, but different perceived risk. Right? So here we have three individuals. One of them is you, right? The other one, Jennifer, and another person, Bud. So the dividends are certain. So everybody, so these three individuals, right, know what are the future dividends or what are the expected dividends. So cash flows or dividends are certain. Everybody has the same information at this stage. But what they differ in is the expected risk of the company, or the required rate of return on the stock. Okay, so you believe that the stock is more risky or less risky? More risky. You believe that the stock is more risky, so your required rate of return is higher, right? So you expect that given the riskiness of this company, you should be compensated at least 15%. You should have 15% return. And the discount rate have an inverse relationship with price, right? If you look at the formula, price is equal to cash flows, future cash flows, divided by 1 plus R. And R is your required rate of return. So inversely related to the price. So given that you believe the stock is more risky, your estimated stock price is $16.67. Jennifer believes that the stock is less risky compared to what you believe, right? So her required rate of return is 12%. So her estimated value of the stock is higher than you, so 22.22. And then Bud believes the stock to be, even less risky as compared to Jennifer. Okay, and we know that required rate of return is inversely related to price. So Bud will put the highest valuation for the stock. Right? So we can see it's the same stock. We all know what are the dividends, right? But where we differ is is the riskiness of the firm, is our estimate of the riskiness of the firm. So in this case, right, Bud placed the highest valuation on the firm. So he values the stock at $50. So who do you think will set the price for this firm or set the price for the stock? You, Jennifer, or Bud? But why? Because he is willing to offer the highest price, right? So for example, if the stock, if I already own the stock, right? And all three of you, all three of these people want to buy the stock, right? You'll put in your offers and I'll offer my stock to the highest bidder, right? So in this case, Bud will determine the price of the stock because he's willing to pay the highest price for the stock. Okay, so the price of the stock will be 50 because that's what the market. Okay, so this is like a small market, small or subset of market where different individuals are valuing the stock. And the value of the stock will be determined by the highest bidder. Okay. Good. So Bud, who perceives the lowest risk, is willing to pay the most and will therefore determine the market price of the stock. Okay. Good. So let's talk about different errors in valuation. So we can make a number of errors while valuing a stock, right? So everybody would know this pricing model, right? It's out there. It's published in the books. It's over the internet. And it's not a very complicated mathematical formula, right? So everyone can use it. Okay, so so the model is there, but remember, this dividend is the next period's dividend, right? Not dividend today. Okay, good. So how can we make errors in stock valuation? There could be problems in our estimation of stock values, in our estimation of firm valuation or stock valuation due to the factors that determine the stock price or that determine the value of the firm. So what are the factors that determine the value of the firm? If individuals or market players differ in their estimates of growth rate, dividend growth rate, right? You might believe that the stock dividend would grow, let's say, at 2%. Another individual might believe that it might grow at, let's say, 5%, right? So there could be differences in estimated growth rate. Another variable where different market players would differ, can potentially differ, is the required rate of return, as we have seen in the previous example, right? And there could be potential issues with forecasting dividends, because if the firm is risky, its cash flows can be volatile, right? Earnings can be volatile, right? So there might be uncertainty regarding the expected dividends or the future cash flows of the firm. Okay. So these factors can potentially differences across individuals or across market players or investors in relation to these variables will result in differences in stock valuation. So let's take a quick look at what will happen or how the value of the firm will change if there are differences in growth rates. Okay, so here I've listed different growth rates, right? And the corresponding values or this value of the stock. Okay, so here we have stock prices for a security that pays a current dividend of $2. So D naught represents current dividend. Okay, and if the required rate of return is 15%, and then we apply a constant growth rate as listed in this table, so we'll see that the value of the stock would change, right? Okay, so how are we going to value the first year? So if, for example, if for example the growth rate is 1%, how would we value it? Which formula will we use? Remember, it's a constant growth rate that we are applying, right? So it's a Gordon's growth formula, right? Okay, so what's the formula?
D naught into 1 plus G.
Good. Divided by R minus G or K E minus G, right? Required rate of return minus the growth rate. Very good. Okay, so if you apply this formula, right, you'll get the valuation of the firm or value of the stock. So you can see if the growth rate is 1%, the value is 14.3. But as you expect the dividends to grow at a higher rate, the value of the stock will increase, right? Because future cash flows are increasing in that case, right? You expect the firm to grow at higher rates, which means the future cash flows will be higher. Okay, and had a growth rate of 14%, the stock would be worth $228. So you can see, if there are differences among investors in terms of the expected growth rate of the stock, they will put different valuation. Okay, they will end up with a different estimated stock price. So that's one source of errors in stock valuation, right? Differences in expected growth rate. Okay, so what we have here is differences in the required rate of return, right? So we have seen this in the earlier slide as well, where we'll work with 3 individuals who have different required rate of returns, right? So in this case, it's the same stock that pays a current dividend of D naught with a required rate of return of 50%, and required returns are at a different required rate of returns. Okay. Okay, I think I made a slight error. It should be a constant growth rate here, right? And then different required rate of return, right? So assume that there is a constant growth rate here instead of required rate of return, right? Okay. So let's say that the constant growth rate is 2%, for example, right? So based on that, because now individuals differ in terms of their estimates of the riskiness of the stock, so they will discount the cash flows at different required rate of returns, and that will affect the value of the firm. And again, here you can see that as the discount rate goes up, the value of the stock goes down, right? Okay, which again kind of confirms there is an inverse relationship between required rate of return and the value of a stock. Okay, so someone who believes that the stock is less risky and requires only 10% would value the stock at 42 pounds or dollars, right? And someone who believes the stock is more risky and requires a return of 15% would value the stock at 21, right? Okay, so differences in required rate of return can potentially affect the valuations. So what you need to remember, right? So, okay. So what is the appropriate discount rate? Or what is the appropriate growth rate? Or what are the expected dividends, right? Okay. So, so you tell me, what do you think is the appropriate discount rate for this firm? Anyone? Anyone has any idea what do you think is the appropriate discount rate for this firm? This hypothetical firm? Right? No? Just make a guess. 5%, 10%, 15%, right? Or 12%? So people will differ in terms of the expected growth rate. They can also differ in terms of the required rate of return. So the key takeaway is that errors in valuation will take place because of differences in expectations of different investors and the required rate of returns and the expected growth rates. So there is no such thing as an exact value, right? So you can't come up with a pinpoint value or pinpoint figure. Okay, so security valuation is not an exact science. It is a combination of some sort of science and art, right? So you have to take into account different factors uh, and take a broader perspective. Use as much information as is available to value the stock. Okay. Right. So considering different growth rates and different required rates of returns, it is important to remember that not everybody will value the stock at the same price. Okay, and because they don't value the stock at the same price, right? Uh, their investment choices will be different. So let's say, assuming that the true value of a stock is $25, right? And because all of you may have different expectations about the growth rates or the required rate of return or the expected dividends, right? So your valuations may vary from 25 pounds, right? As long as your valuation is below 25 pounds, right, you will believe that the stock is overvalued. Okay? Sorry. If you come up with a valuation, so let's say you do your calculations and you find that your valuation is 20 pounds, for example, right? Which is less than 25. Okay? So if the stock is trading at 25 and you value it at 20, what will you do? Will you buy it? No, you will not buy it, right? Because you believe the stock is worth only 20 and currently it's trading at 25. So you would believe the stock is overvalued, right? Okay, and then the vice versa is true. If your valuation is higher than 25, you will believe the stock is undervalued and then you'll buy the stock. Good, so this is the discussion question that I showed you last week as well. Did I? Did you see this question last week? No? Okay, so today I told you that I might be recording the lecture and nobody's talking. Last week, I recorded the lecture, but I didn't tell you. So everyone was participating. Okay. So what I want you to look at is to see how this Gordon's growth model that we covered can potentially be used to explain the stock prices during the financial crisis. Okay, so we know during the financial crisis, stock prices dropped significantly. How the Gordon growth model can potentially explain the drop in prices during this period. Okay, so the other topic that I mentioned that we are going to cover in the first part of this session is about the riskiness, and then we will look at which one? Rights issues. Well done. Okay, good. Okay, so stocks required rate of return. So we know that the required rate of return should depend upon the riskiness of the firm, right? So none of you up till now has asked how will you determine the risk, right? Because if you don't know the riskiness of the firm or how risky the stock is, then you can't come up with your required rate of return, right? So how do we measure the risk of a stock? There are a number of models that we can use to estimate the risk of a stock, but we'll be looking at this very basic and fundamental asset pricing model, which we call CAPM, capital asset pricing model. So there are variations, there are different, as I said, there are um, other models out there to come up with or to estimate the riskiness of a stock. But the underlying assumptions are fairly similar. Okay, so what is capital asset pricing model? So it's used to estimate the required rate of return for any firm that's traded publicly. Okay, as long as we have information about firms uh, firms historic returns, right? We can come up with the expected required rate of return for this stock. Okay, so the only important risk of a firm is actually systematic risk. So the risk is defined into two categories, systematic risk and unsystematic risk. So systematic risk is the common risk that's shared by all firms that operate in a risky market. Unsystematic risk is a unique risk of the firm. Okay, so why don't we care about unsystematic risk?
Because that can be controlled.
That can be controlled. How?
The firm.
That can be diversified away, right? Okay, so you can potentially diversify the unsystematic risk, right? But because all the, so through diversification, you can, invest in different stocks, right? You can diversify your investment. And as you diversify your investment, unsystematic risk can be minimized, right? But because all the stocks, all the firms, for example, that you invest in operate in the market and they are exposed to the market risk, right? For example, economy can grow or it can, shrink, right? Interest rates can rise or interest rates can decrease, right? Okay, so they're exposed to the market risk. They're still exposed to the market or systematic risk. So this, as we know, the systematic risk is what we should care about, and because unsystematic risk can be diversified away. So do you think there should be compensation for taking on unsystematic risk? So okay, let's start with this. So So as we now know that systematic risk is what matters, right? And not the unsystematic risk. Okay. So if the systematic risk of a stock is higher, for example, you will require a higher required rate of return, right? Okay. That's what we know. Higher the risk, higher should be the expected return. Okay. So if the systematic risk of a stock is higher, we should require a higher return. But let's say there is a stock that has a systematic risk component and an unsystematic risk component. That will be the total risk of the stock, right? Okay. So risk is essentially price, right? Risk is price into your required rate of return. So as we know, if the risk is higher, your expected return will be higher. Okay. So given that there are two components of the risk, right? Should you be compensated for taking on unsystematic risk? So the total risk is systematic plus unsystematic risk, right?
Yeah.
If you take on a stock if you invest in a stock that has unsystematic risk as well, right? Okay, so the total risk will be higher. Do you think you should be compensated for that?
No, I think.
No? Why not?
Because that comes on to the efficiency of each firm, how well they are with diversifying their risks.
Okay, so you're talking about the firm diversifying their own risk.
Yeah, so that part can be diversified a bit. However, the systematic risk is the market risk, which is not in their control and which is there for everyone else. That's where they should be compensated.
Right, but we're talking about firm managing its risk, right? But here we are talking about investors who are investing in a stock of firm, not the firm diversifying itself, right? Diversifying into different projects. Okay. Um, yeah, I mean, the firm can potentially reduce its risk by investing in different projects, right? So the firm itself can diversify, right? But let me ask a related question here. So do you think the firm should diversify?
I was going to ask your
You're going to answer the first question. Okay,
Yeah.
go ahead.
So should unsystematic risk be rewarded?
Yes.
Right, that's the question. I think yes,
Okay.
because that unsystematic risk would measure like the specific company's change towards other market factors, so towards the market. So, for example, if there's a lot of unsystematic risk, then it's a lot more risky, but it's a lot more volatile. So it's more likely to go up in price if the general market goes up. But at the same time, because of its high risk, it's more likely to go down if the general market goes down as well.
Okay, good. But that's actually not true, right? You should not be rewarded for taking on unsystematic risk, right? Because you can diversify away, right? So market should not compensate you for a risk that can be eliminated by simple diversification. So there's no reward. There's no compensation for taking on unsystematic risk. So as investors, you should always diversify. Try to minimize the unsystematic risk component. Okay.
Does that that's in theory? Does that actually work in the real world as well?
Absolutely.
Okay.
Everything that we learn in this module is what happens in the industry. Okay. So think about this, right? Well, this is actually it's good that we're coming up with different arguments, right? So that we can try to rationalize it, right? So if there is a risk that can be minimized or that can be reduced, right? Why would the market compensate me for that? It makes no sense. If I am taking on that additional risk, it's my choice, right? But there should be no compensation for it because that could be reduced or minimized, right? And let's move on to the next question that I asked you, which is very much related to this. So when I asked you whether market should compensate you for taking on unsystematic risk, so she mentioned that the firms need to diversify, right? Firms can reduce that. If the firms diversify, firms might be reducing their overall risk, right? Okay. Then I asked you the follow-up question: do you think that the firms should diversify? Is it so? If you are a manager of a firm, right? Do you think it's important to diversify or reduce the riskiness of the firm? You need some time to think. You all understand the question, right? Okay. Okay, anyone?
So if a firm intends to, if a firm decides to reduce its risk
Yeah.
through diversification or anything, but it won't be with the objective of maximizing returns to shareholders, would it? It will be with the objective of reducing the uh, firm's risk, right? So as an investor, if I need to maximize my returns, then it should be, I mean, I should be the one diversifying my risks, not the firm doing it for me.
Very good. Okay, so that's the bottom line, right? So why would the firm diversify, right? So firms are, so these publicly traded companies, these are run by professional managers, right? If managers start diversifying, okay, and a lot of firms, do this, right? A lot of firms do diversify to reduce the firm's specific risk, right? Or reduce the riskiness of the firm, or to have more stable cash flows, right? But what does it provide to the shareholders or investors? So you have to think in terms of investors, right? If the firm diversifies, so who gets more secure? The managers, right? If the volatility of the cash flows will decrease because of diversification, managers will get entrenched, right? It's, you know, they will feel safer, right? Okay. But from an investor's point of view, why would you ask managers to diversify when you can diversify yourself? So think about this. So you have a pool of money and you have to choose between risky firms, less risky firms, medium risky firms, and let's say, risk-free assets. Okay? So would you give your money to the firm and then ask them to invest in less risky assets? Right? Maybe not, right? Because you can do this yourself. Okay? So there's so there's a pool of firms which vary in different vary in their risk levels, right? And then you as investors can potentially choose projects or choose investments, right, that fit your risk tolerance levels or your risk preferences. Okay, if you are a risk loving person, right, you may have a portfolio that's, you may invest in stocks or have a portfolio of stocks that have higher riskiness. Okay, or if you're risk averse, you may choose less risky investment. Okay, and quite a lot of people, have a combination of both.
Yes, I just have a small question on that standpoint. So like, let's say you have like small firms tend to outperform big firms, right? Uh, so based on this theory, this farm and French theory, is it is it safe to say that that extra return you get from investing in a small company is a reward for you for taking on extra unsystematic or idiosyncratic?
No, okay. So, okay, we haven't talked about power French model yet, but it's another asset pricing model, right? It also tells you how risky the stock is. So, uh, this question is based on academic literature that shows that small firms tend to outperform larger firms on average. Okay. So how can you? So the question is, how can you justify this? So if this is true, right? If this is true, and then let's just assume for a minute, if they have the same riskiness, small firms and large firms, assuming that if they have the same riskiness, then everybody would buy small stocks, right? Because they outperform, right? And if everybody starts buying the smaller firms, what will happen to their price? Their prices will increase, right? Okay, and as a result, the long-term returns of the returns will go down. Okay, so what Thomas French suggested that it's why small firms outperform is because their riskiness is higher. They have higher risk compared to larger firms, right? and small firms generate higher returns or outperform is because they have higher risk, right? It's not that it's unsystematic risk, okay? It's still a systematic risk, right? Because small firms tend to be more risky compared to larger, more diversified firms.
Sorry, okay, so in that case, how do you define unsystematic risk? How do you compare it between a company itself risk and unsystematic risk that can be diversified?
Okay, so the question is how can you differentiate between systematic risk and unsystematic risk? Okay, so I've said each firm or each asset would have two components, right? There's a systematic component that changes with how the market is behaving, right? Okay, and an unsystematic component that is specific to the stock or the asset. Okay, so because the unsystematic component, so think about this. So let's say you have a pool of assets or pool of stocks, right? How would the market compensate you? They all have different total risk, right? So at this stage, I'm not going to teach you how to calculate systematic risk or how to calculate the induced and the unsystematic risk and sum them up to get total risk, right? So because we know the market only compensates for the systematic risk, right? And that's what we are going to look at in today's session. So going back to the example, if we have a pool of assets, if you have a pool of different stocks or different assets that have a systematic component and unsystematic component. The unsystematic component is random. Okay? If you are diversifying, right? So in some cases that will be you'll get compensated. You will have a higher return, right? But that unsystematic component will generate positive return, let's say. In other cases, it will be negative, right? On average, it will be close to zero or zero. Okay? So that gets cancelled away. Some firms will do better, some firms will do worse, and on average, that component collapses to zero or close to zero. So what's left is the systematic component, and that's what the market would compensate you for. Okay? Because all of the stocks are still in the market. They still respond to how the market is going. Okay, so the unsystematic part cancels out with diversification.
Yeah.
Does it make sense?
Yeah.
Okay, good. Good, very good. Okay, so how do we calculate the systematic risk component using the capital asset pricing model? So, so this formula represents the required. So you can use this capital asset pricing model to come up with the expected return of any stock. So how do we calculate that? So here we have the expected return of security J that we are interested in. So what should be the expected return of the security J? It should be equal to the risk-free rate plus a compensation representing the riskiness of the stock. Okay? So if, for example, this stock is risk-free or this asset is risk-free, right? So the required return on this asset J should be equal to the risk-free rate. But if this is more risky, right, then this component is the compensation for additional risk, right? And what measures this systematic risk is this beta of this stock, okay, or beta of this stock J or asset J, okay? So you can see higher this beta, the greater the riskiness and greater will be the expected return for the stock. So beta measures the systematic risk of the stock. What's in the bracket? RM is the return on the market. Okay, and RF is, again, as we know, is the risk-free rate, risk-free asset, or risk return or risk-free asset, right? So what's RM minus RF? It's what we call the market risk premium. Okay. Okay. So now think about this, right? So this is market risk premium because you decided to invest in a risky market, right? You could have invested in a risk-free stock, right? And if you could have invested in a risk-free stock, this beta would be zero. All of this term will be zero, right? Okay. But because you decided to invest in a risky market, you should be compensated for taking on this additional risk, right? How much should you be compensated would depend upon the riskiness of this stock. That is determined by the beta of this stock. Okay, so as I mentioned, beta measures, so this beta is measured as the covariance between the return of the stock and the return on the market, okay, which reflects the asset's sensitivity to the general stock movements, general stock market movements. Okay, so this measures how the stock's returns co-vary relative to the market. Okay. Good. Okay. So estimating the market risk premium. So in this equation, so we talked about this, right? So RM minus RF is what we call the market risk premium. So how do we calculate this market risk premium? So it's the yield on newly issued treasury bonds. So the yield on newly issued treasury bonds is commonly used. That's what we use as a measure of risk-free rate that you can earn. Okay. And the term RM minus RF, as we know, is the market risk premium. So it gives you the excess return, right? So this is basically excess return, right? Return above this risk-free rate because you're investing in a risky market. Okay, so it's market risk premium is the excess return for investing in a risky market, right? Okay, so historical data for 30 or more years can be used to determine the average market risk premium over time. So if you have to look at, what is the risk premium over the period, right? You can look at the past or historic data, and then you can come up with a measure of the average market risk premium during that particular period. How do you estimate the beta, right? Because as I said, beta is a key measure, right? That determines the riskiness of the stock. How do you measure the beta, right? So those of you who have taken some econometrics or statistics, you would know that we estimate beta typically by using a regression. Sorry, what?
Sorry, nothing.
Okay, so we use this. We calculate beta using regression analysis. So we run a regression of the firm's return against the market returns. Okay, and we get the firm's beta. So that shows the sensitivity of firm's returns relative to market returns. Yeah.
So is the firm's return the dependent variable?
Is the firm returns dependent variable? Okay, what is dependent variable?
Why?
Why? That's inside of the equation, right? Yes. Okay. So you regress firm returns on the returns on the market. Good. Right. Okay. Right. So what I have here is what we call the security market line. Okay. So this security market line determines the riskiness of the stock. Okay. So you can see it starts from RF and not from here. Why does it start from RF? Not from the point zero. So on the horizontal axis, we have systematic risk determined by beta, and more on vertical axis, we have expected returns, right? So why does this line start? So what we should expect as the risk increases, return should go up. So it's like upward sloping. That's what it is. But it doesn't start from here. Why does it not start from here? Right, because even if you are so there is a risk. If there is a risk-free asset, right? Okay, which means that has zero risk. If you're taking no risk, right, you will end up earning the risk-free return. So that's why it starts from here. So look at this equation, right? So if you put 0 in this equation, beta equal to 0, what you're left with, Rj is equal to Rf, right? Okay, so if the riskiness of the stock is 0, you'll earn risk-free rate. And as the riskiness of the stock will go up, the expected return also goes up. Okay, so the market risk is generally represented by this beta equal to 1. So beta equal to 1 represents the market risk. Okay, if a stock has a beta exactly equal to 1, right, this is the return that you should get, right? So you should earn the market return. Okay, good. Right. If so, as long as you fall on this security market line, right? Okay, as long as you fall in the security market line, you're getting the appropriate, your expected return is proportionate to the riskiness of the stock. Okay, but there could be cases when when a firm's stock or when a firm or an asset may fall below the security market line or above the security market line. Okay, if it falls below the security market line, what does it mean? So let's say you're here, right? Okay, so let's say you're at this point. So what does this show? This is the beta of the stock, right? If this is the beta, what should be the expected return? Slightly higher than the market, right? But you're only providing a return equal to or close to risk-free rate, right? What does this mean? That this stock must be overvalued, right? It's a risky stock, but providing a lower return. So at this point, it is an overvalued stock. Okay, if it falls above the market line, security market line, then that's an undervalued stock. So think about this. Given, let's say, this point, right? Okay. So if we look at this point, for example, okay, so this is the riskiness, right? Given this risk level, the expected return should be equal to somewhere here, right? But it's giving a more return, right? It's providing you higher return. The reason it's providing you higher return is because at this point it's undervalued. Okay. So what will you do? You will buy undervalued stocks, right? And you will sell overvalued stocks. Okay, provided you're able to accurately determine these are undervalued or overvalued stocks, right? So now we have another tool. We look at the riskiness of the stock, right? And using the riskiness of the stock, we come up with the expected required rate of return on the stock, right? So previously, when we're talking about errors in stock valuation, we looked at differences in expected risk, right? Will generate different stock values. Okay. So if you can accurately measure the riskiness of the stock, using the CAPM model, you would know what is the appropriate return for this stock given its risk level. And that is the required rate of return you should use in valuations. Okay? Good. Okay, so any questions here?
What is the proxy that's used for calculating RM, the market?
Then that's the average market return. So how do we calculate the average market return? Okay. So this is a good question, right? How do we calculate what is the market return, right? Okay. So theoretically, the market return should be the average return of all assets, right? This could be stocks, bonds, precious metals, other natural resources, right? Okay. But to create such a portfolio is difficult, right? Okay. So what we do is that we come up with a proxy for expected market return, right? So this is generally some sort of index. Okay. So for example, S&P 500. So we may use S&P 500 as an approximate return of the market for a particular period. Okay. So people again can use different indices, right?
This is just a bit of a practical question. Let's say domicile I live in Uganda. Which risk-free rate should I use? Should I use the one of the US or the one of my country?
Okay, good. Again, good question, right? So if you live in a different country, right, which risk-free rate should you use? Anyone want to answer this one? Yeah?
Where the company is based.
Where the company is based, right? Where you're investing, right? Okay, so if you're investing, let's say in the US, you should be compensated for taking on the US market risk, right? Okay, and to value the riskiness of your investment, you should you potentially use the returns offered by risk-free securities in the US, right? But now, because of internationalization and technological advancements, we can create international portfolios as well, right? Okay. So again, so as I said, valuation is not an exact science, right? So you have to think about what is appropriate, okay? And what seems appropriate given the investment choices that you're making and given the environment, that's what you should use. If you're investing in Uganda, then clearly you should use the risk-free rate offered in that market. Okay.
Even if the government just defaulted on their bonds and stuff, and I know it's not really a risk-free rate, I should just use it.
Okay. So even if the government is defaulted, right? It's not a risk-free rate, right? Okay. If it's not a risk-free rate, what will be its return? Higher than what's offered in the US or less than what's offered in the US or the same? Higher, right? So the higher return represents that it is not risk-free, right? Okay. If a country is in default or close to default, the required rate of return on its debt goes up, right? So the return, so we call it, so when we talk about these risk-free assets or treasury stocks in the earlier sessions, I told you these are not risk-free, right? These are close to risk-free, right? So if a country has higher default risk, which means the return, the expected return on that country's bonds will be higher, right?
Thank you.
So it's reflected in the return already. Okay, good. Anything else? No, very good. Okay, so let's talk about rights issues. So it's a slightly different topics. from what we have just covered. So we looked at equity valuation, right? So if the rights issues are when a company that's already trading issues more shares, right? If it issues more shares, if it offers additional shares to everybody, right? Then that's what we call season equity offerings. Okay, that's called seasoned equity offerings. But if it gives the existing shareholders the first right to buy these additional shares, that's what we call the rights issue. Right? Okay, good. Okay, so keeping everything constant, right? Let's say everything remains unchanged. What would you prefer a firm to do? Let's say all of you are stockholders, investor in a firm, right? What would you like the firm to do? If it needs to raise additional capital or additional equity, right? Would you want the firm to do season equity offerings, or would you want the firm to do a rights issue?
Please say that again.
Okay, I'm going to repeat it, okay? Good. Okay, so let's say we have a firm, right? And all of you are shareholders in that firm, right? Which means all of you have some sort of ownership stake in the firm, right? Because you hold the shares of the company. Okay. Now the company needs to raise additional equity. Okay. What would we like the firm to do? Do a seasoned equity offering or do a rights issue? Okay. Good. So those of you who think it should be a rights issue. Is it a hand or a raised hand or not? Okay, those of you who think it should be a seasoned equity offering. You can use, and then why? Okay, it doesn't matter now. Why I'm not sure. Okay, good, thanks. Probably the right issue, right? I told you in the very first lecture, right? You were present in the first lecture, right? You two, yeah, right? I told you you have to make a choice, right? It doesn't matter whether your choice is right or wrong, right? You have to make a choice. Good. Right. So what do you think?
I said rights issue.
Right issue?
Yeah.
Okay. Sorry? So he doesn't want the firm to issue any additional shares at all, right? Not season, neither season equity nor the rights issues. If the firm doesn't issue shares, right, additional shares, how it's going to make investments. Yeah? So it will lose potentially positive NPV projects, right? So we haven't talked about NPV, but that's mainly corporate finance. So it will lose good investment opportunities, right? Okay. So you will be worse off, right? If the firm makes good investment choices, the value of the share will increase, so you'll be better off, right? If the firm doesn't issue anything and doesn't invest, then you don't get anything. Okay. Okay. So quite a lot of you will go for rights issue, right? Okay. Why do you go for rights issue? Anyone? Why there's a preference for rights issue? So you have made this choice, right? A lot of you, nearly like 90% of you, wanted the company to issue shares through this rights issue, right? Is there any reason for this choice, or you just think that is better? There's one obvious advantage of rights issue, right? Yes, what? What is it?
If a company does a seasoned equity offering, I'm not sure, but will I tend to lose my shareholding facilities in the company?
Right, exactly. Okay. So if the company issues additional shares through seasoned equity offerings, right, then your percentage ownership in the firm is likely to go down, right? Okay, because now there are other shareholders who will share in the value of the firm, right? Yeah. So let's say previously, for example, you own 5% of the stock, right? Now the firm issued additional shares to other people as well, other investors. So your proportionate stake in the firm will go down, right? Now it will be less than 5%, right? Okay. So the firm does rights issue. One key advantage of rights issue is that because it offers the existing shareholders the first right to buy these additional shares, and if they do exercise their right, to acquire these additional shares or buy these additional shares, then they can maintain their proportional stake in the firm. Okay, so the ownership does not get diluted. Okay, we call it dilution, right? Okay, if the proportionate ownership of if your proportionate ownership in the firm goes down, that's what we call dilution, right? Because your stake in the firm gets diluted, reduced. Okay, so one key advantage of rights issue is that your proportionate ownership stake in the firm remains unchanged. Okay, provided you exercise the right, provided you use this rights issue to buy additional shares. Okay, good. But as it says, it's a right issue, so it's a right. It gives you the right to buy additional shares, but it's not an obligation. Okay, so you can choose not to buy additional shares. So, for example, if you are not really happy with the company and you don't really like it, right? And you may not want to increase your investment in the firm, so you don't really have to buy it. But if you don't buy it, there is a cost. Typically, there is a cost, okay, which we will talk about in a few minutes. Okay, so it's a right, but not an obligation to buy additional shares. So normally the rights issues are offered at a discount. Okay, which is pro rata to the shareholdings of, which is pro rata to your shareholdings for a limited period of time. Okay, so because these rights issue typically come at a discount, right? If you do not exercise your right to buy additional shares, you forego that discount, right? Okay, so if you don't exercise it, there is a cost to that. And that cost is equal to the discount that you forego because you have decided not to buy or not to exercise your right to buy additional shares. Yeah.
So I have two questions. What kind of shares can be issued? So is it preferred kind of shares or common kind of shares? One. Sorry. Two, is there a preference when they do rights issue? Do common shareholders have the first? Sorry, do they are they the first to buy or is it open to all shareholders at once?
Okay. So the first question. So it's typically done on common shareholders, common shares, right? Common stock.
Yeah.
The second question is I'm unsure about what is it?
Okay. So when they offer this rights issue,
When they offer the rights issue,
do they offer it first to common shareholders before preferred shareholders, or they offer it to all shareholders at once?
right? So okay. So do they offer it to all shareholders, which include common shareholders and preferred shareholders, right? Okay. So it's if these are additional shares which are common shares, right? These will be offered to common shareholders, right? Okay, because preferred shareholder is a different type of security. Okay. Preferred shareholders do have an ownership stake, but it has characteristics of both debt and equity. So it's a different security. So depending upon what's being issued, if the company is issuing more common shares, and normally the company issues common shares, right, through this rights issue, so it should be offered to common shareholders so that their proportional stake in the firm remains unchanged. Okay, good. So one key point that it's a right but not an obligation. Okay, if you decide not to exercise this right, there's a cost to it, and that cost is that you forego the discount. You lose the discount that's offered on this rights issue. Okay, so an existing shareholder. So how these are offered, right? How these right issues are offered. So an existing shareholder can buy X, for example, X additional shares if they hold n number of shares, if they already own n number of shares. Okay, so these are offered like this, like for example, 1 for 2, which means if you have 2 stocks, you have the right to buy 1 additional shares. Or it could be like 3%. If you have 7 shares, you can buy 3 additional shares. Okay, so you can buy X number of shares provided you hold n number of old shares. So new shares, as I mentioned, is new shares are offered at a discount, which we call the subscription price, right? Which means the subscription price will be lower than the market price. Okay, good. So the rights are valid for a given period of time, right? They have an expiry date, which we call the X-right date. Okay, and after the X-right date, there will be a new price of the stock, which we call the X-right price. Okay, good. So any investor should buy a share before the X-right date to benefit from this rights issue. If they hold or if they buy the share after the X-right date, they're not entitled to this right. Okay, so this X-right date is important. Good. Okay. Okay, so here we have an extract from a Standard Chartered right issue in 2015, right? Okay, so it gives you some information about about the rights issue. But what's important for you is highlighted here in red, right? So what is being offered? So what's being offered is 2 new ordinary shares for every 7 ordinary shares. So remember, X new shares provided you hold n number of old shares. So this means you can buy 2 new ordinary shares if you already own 7 old ordinary shares. Okay, so as long as you have 7 shares, you're entitled to buy 2 additional shares. So it's like 2 for 7. Okay.
Sorry, ordinary shares, yeah, means common shares, right?
Yeah, ordinary shares mean common shares. Okay, and that they're held on 18th November 2015, the record date, at a price of 465 pence per new share, right? So it tells you the price at which the new shares are issued, which we call the subscription price. Good. Okay, so let's look at this case. So from this, what do we need? What do we know? You need to have 7 old shares. You need to have 7 old shares to give you the right to buy 2 additional shares. Okay, so these could be exercised a few days before the date that's mentioned, right? Okay, and we know the subscription price, 465 pence, or in other words, £4 and 65 pence, right? So that's the subscription price. On November 16, 2015, the share price was actually £6, right? Okay, so there is a discount of £1 and 35 pence per share. Okay, so the £6 is the current market value on this date, right? And you can buy additional shares at a lower price, which is what we call the subscription price, £4 and 65 pence. Good, so you can work out the discount per share. So the question is, what can shareholders do with their right? So what are the options? So if the company offers these rights issue, what are the options for you? Option one is that you take up all or some of the rights. So you don't necessarily have to exercise the right to buy all additional shares, right? You can do proportionate as well. So you can take up the right, exercise your right to buy additional shares. That's one thing, and that you can only do if you have, if you're a shareholder. If a shareholder has 7 old shares, right? So they're entitled to buy 2 new shares, and each new share costs 4.65. So as long as a shareholder has 7 old shares, they can buy 2 new shares by paying the cost of £9 and 3 pence, or 30 pence. £9 and 30 pence. Okay, right? So that's 4.65 times 2, right? As long as you have 7 old shares. So that's option one, which is exercising the right to buy additional shares. Option two is you sell all or some of your rights. Okay. So if you decide not to buy additional shares for whatever reason, right, you can sell your right to buy additional shares. Why can you sell your right to buy additional shares? It must mean that these rights have a value, right? That's why someone is willing to pay a price for it. Okay. Why there's a value to this rights issue? Because of the discount. Because the subscription price is lower than the current market price, right? So these rights entitle you to buy additional shares or more shares at a lower price. Okay.
I have a question.
Yeah.
So where do they sell these rights?
In the market to other shareholders.
Oh, okay.
To other shareholders, right? So let's say I have like 14 shares, right? And let's say I have savings of £10, for example, right? To buy additional shares. Okay. So 14 shares entitled me to buy 4 additional shares. Let's say I don't have funds to buy 4 additional shares, right? Because I only have £10. So I can buy 2 additional shares, but not the others, right? Not the additional 2. Right? So I can sell the right for the other 2 shares, right, to someone else. But what's the market for this? There should be other investors, right? Other shareholders, who want to increase their shareholding in the firm. And the third option is that you do nothing, right? Let it go, right? Ignore the rights issue. So this is not recommended. Why it's not recommended? Because there will be a clear loss, right? Okay, so the share in 2 forms. Firstly, your shareholdings will get diluted. You will own your proportionate stake in the firm will go down, and secondly, you will lose some of the value attached to these rights issue, which is mainly because these rights issues are offered at a discount.
Can shareholders buy the shares at the discounted price and then instantly sell it at the market price?
Yes.
Okay.
Okay. So the question is, can existing shareholders exercise their right to buy additional shares, right? And then, once they have these additional shares, they can sell it in the market. Yes, absolutely. Because, after exercising the rights, it's their share, which they can sell in the secondary market. Okay, good. Okay, good. Right. So benefits of a rights issue. So something that we already discussed. So I'll go through this relatively quickly. So firstly, you can acquire additional shares at a lower price, right? There is no need to decide a price as the discount price is based on the existing price, which is the market price, right? So you don't have to determine the price because subscription price is already given to you. There are no regulatory limits on discount or size of the issue. So you bypass these regulatory requirements. Disclosure requirements are much lower if you are issuing additional shares through rights issue as compared to any other form. So one key advantage that we talked about earlier is that if you exercise these rights, you maintain your proportionate stake in the firm. So you avoid dilution by exercising your right to buy additional shares. So the rights issue is decided by the board of directors without any approval required from the stock exchange, right? Because you're not offering it to other investors. You're offering these to existing shareholders. So it does not require any approval from the stock exchange. Okay, so the drawbacks of a rights issue is that these are costly to the firm, right? These are costly. Why? You still have to pay. So it is underwritten as in the IPO. So you still have to pay the associated fees, right? Which means there are high underwriting fees that you would have to pay. There is a limit to how much capital that can be raised, as that would depend upon um, as that this would depend upon the interest of existing shareholders in the company, right? Okay. And lastly, the timing is important. Time is an important issue. The shareholder notice meeting and the offer period should run concurrently. Okay, so you have to be careful about the timings. Okay, when these could be issued, and so there is a timing issue that you have to be careful, right? As the shareholder notice meeting and the offer period should run concurrently. Okay, so how it works. So the first thing that the firm management must decide is what should be the subscription price, right? Or in other words, the management needs to decide how much discount do they want to offer, right? So mathematically, this could be represented as follows. So PS, which is the subscription price, right, is lower than P naught, which is the current market price, and the amount that is lower by is the percentage discount offered on the stock. So here D represents the discount on the firm or percentage discount on the firm's stock. Okay, right? So P as our subscription price will be the current price times 1 minus the discount rate. Okay. So, uh, so once you have determined the subscription price, the next thing you need to determine is how many rights are you going to issue, how many additional shares you're going to issue, right? So for this, you need to know how much capital do you need. So if we do not, the capital that needs to be raised by F, right? So F divided by subscription price will give you the number of new shares that you will issue, right? Amount that needs to be raised divided by price that you're charging per share. Okay? So that will give you the additional shares that needs to be issued. And then you can transform these additional shares or represent these additional shares in a percentage format as well. So if the company already has n number of shares outstanding, right, the number of rights per new share would be determined by the following equation. So n is the existing shares, right, or all shares outstanding divided by the new shares that you're issuing, right? So this relationship will determine how many shares someone will get conditional upon how many shares they had previously. Okay. So after the rights issue, the company will have n all shares valued at the price P naught, right? Okay. And then n star new shares, which are valued at subscription price PS, right? Okay. So what do you think will be the price after the expiry date? P naught, PS, greater than P naught, less than P naught, greater than PS, less than PS. What do you think will be the expiry price? Less than? Less than P naught? Okay, good. Anything else? So less than P naught is correct. But this is part of the answer, right? It should be higher than PS as well.
Yeah.
Right? Okay. So the new price should be between PS and P naught, right? Because the new price is the average of new shares and all shares. Okay. Good. So good. So the new price will be the average price. Okay, so this is the X right price, right? Which I set as new price, right? Okay, so the new price or the X right price, right, will adjust after the rights issue, right? And it is calculated as the weighted average of the two prices, which is the current market price P naught and the subscription price PS. Okay, so this is the weight. This is the weight of all shares, right? So now, what was that? Number of all shares, right? Okay, what's the denominator? N plus N star, all shares plus new shares. So this is now the total number of shares outstanding, right? So all shares divided by total number of shares outstanding. That's the weight of all shares out of total shares now. The weight of all shares times price of all shares plus, so this is the weight of additional shares or new shares times the subscription price, right? So that's the weighted, the X right price is the weighted average of the two prices P naught and PS. Okay, so and we already determined that this X right price should be between P naught and PS. Okay, the value of the right can now be determined by the following equation. So P naught is the current price, right, before the rights issue, and PX is what we determine the X right price, the price after the rights issue. Okay, so the difference between the two is equal to the value of the right. Okay, So the value of a right is the difference in prices. Okay, price before the rights issue and price minus the X right price. Okay, let's quickly look at an example. Okay, so here we'll continue with the example that we had seen earlier. So Standard Charter's chartered rights issue. So the offer is 7 old shares for 2 additional shares. The subscription price is £4.65 per share. The the pre-rights price is £6, which is the price today, P naught, right? So assume a shareholder with 7 old shares who exercised his or her right to buy 2 additional shares, right? So what is the total value of his holdings? So he already has 7 shares, and the price of those 7 shares is 6, right? So 7 times 6, that's the value of all shares, plus he gets 2 additional shares, each at the subscription price 4.65. So that is his total investment in the stock, right? Total value of his investment in the stock, right? 51.3. Okay. So what is his number of shares after the exercising his right to buy additional shares? He already had 7, then he bought 2 additional shares, right? So total 9 shares, right? And now what is the average price? Total value divided by number of shares, and that gives you the price per share, right? So the price per share is £5.70 per share. Okay. Pre-rights issue price was 6. Okay. And the average price after the rights issue is 5.7. So what is the value of a right? P naught, which is the pre-rights issue price minus the PX, right? Which is X right price. So the value of a right, value of one right is 30 pence. Okay, does it make sense? Okay, good. So the share price dropped from £6 to 5.7 pounds. So if the company issues a rights issue, we should expect the stock price to go down, right? So it has gone down from 6 to 5.7 in this case. So the question is, does it mean that the shareholder had a capital loss? No? Yes? So the price per share has gone down from 6 to 5.7, right? Is it a capital loss? No. Why not?
Capital gain is PX minus P. Right?
Capital gain is PX minus
P subscription.
PS. Okay.
Yeah, so it's 5.7 minus 4.6.
5.7 minus 4.65. Calculate that. What do you get?
1.05.
1.05.
I don't know.
That's the capital gain.
Yeah.
No, you don't know.
I don't know. I don't know.
Okay. Good. So apparently, it appears that there is a capital loss, right? Because previously each share was valued at 6. Now each share is valued at 5.7, right? Okay, so there is a drop in stock price, but in reality, the shareholding remains unchanged. So the value of the investment in the value per shareholder in this firm remains unchanged because the drop in value is compensated by the discount offered on additional shares. Okay, good. Okay, good. So let's see.
Oh,
Okay, so PX minus PS, right? Which is so shareholders anticipate a capital gain, right? Buying cheaper than the market, right? So they're entitled to buy additional shares, right? So 5.7 is the new price, right? Minus the subscription price. So what they gain is 1.1 pound and 5 pence, okay, per new share, right? And given that this is like uh, 2 for 7, right? So the total gain from buying 2 additional shares is 1.1 pound and 5 pence times 2, right? Which is 2 pounds and 10 pence. Okay, so that's the total gain from buying 2 additional shares. Okay, so this gain is exactly, so the gain that you have on these 2 additional shares is exactly equal to the loss that you have on all shares, right? So the decrease in price was from 6 to 5.7. So per share, there was a decrease of 30 pence, right? So all shares decreased in value by 30 pence per share. And there were 7 shares, right? So 7 times 30 pence is equal to 2 pounds and 1 pence. So the gain from additional 2 shares, and that gain, the reason you have a gain is because those shares were offered at a discount. Okay, it's exactly equal to the loss that you have on your old shares by um, the, that is there due to the decrease in price. Okay, so the two offset each other, so the total shareholder wealth remains unchanged. Okay, so the price drop that we see is basically mechanical, right? And it has no effect in the wealth of the shareholders. So theoretically, the rights issue, okay. So if the price drops from 6 pounds to 5 pounds and 70 pence, right? Okay, that should be the new price, right? If you have this rights issue, the new price must be 5 pounds and 70 pence. If it is any different than this price, right? Okay, then that's not because of the rights issue, but because of something else that might be happening with the company. Okay, so here we assume that rights issue carry no new information. Okay, and with no new information, the firm value should not change. Okay, and the firm value will not change only if the price after the rights issue, if the X right price is 5.7. Okay, so rights issue simply increase the value by the amount of new capital that you're raising, right? Okay, but but because you're raising additional capital, you're issuing additional shares as well. So the average value of the firm remains unchanged.
I have a question.
Yep.
How do you know, for example, now this person had 7 shares. How do you, if someone had like 49 or 700 shares, how do you know the right amount to buy to make sure there's no real fall in value for your shares?
Right. Okay. So, so the question is, how do you determine what is the right amount to buy, right? What is the right number of shares to buy, right? So the terms of the right issue will determine how many additional shares you can buy, right? Then it's up to it's up to you how many of the rights you want to exercise, right? So let's say you have 500 shares, for example, right? Okay, you may not want to buy shares equivalent to your right that you get from having 500 shares. You may want to buy, let's say, much lower amount. Okay, but what you need to do as an investor is whatever rights that you're not exercising, you must sell them because they have a value. If you don't sell them, then you will lose. You will have a capital loss in that case. Okay, even if you're not, even if you don't want to buy the additional shares, the complete number of additional shares that you're entitled to, right? That's perfectly fine. But because each share has a right, and we determine the value of a right. If you don't sell it, you will lose that value. Okay? If you don't want to buy additional shares, you sell the right to buy additional shares to someone else. Okay? Good. Right. Okay. So good. So that's the first part of today's session. Let's have a quick 5-minute break, exactly 5-minute break. Okay. And I will start exactly after 5 minutes. Okay.